What's going on, everyone? Welcome back to another YouTube video. In this video, I'm going to be doing a trade recap of a trade that I personally took on Monday, the 18th of August, 2025. So let's get right into it. So as always, the first thing I'm going to be looking for when I try to execute a trade is, number one, is a sweep of liquidity. Whether that being previous session high, previous session low, such as London highs or lows, Asia highs or Asia lows, previous day lows or previous day highs, or any other buy side or sell side liquidity. But preferably, I want to be looking for a previous session high or low to be swept, as it is more probable that the trade will play out. So as we can see right here, we do sweep London lows at 958. So the first step has been already achieved here. So as soon as we sweep that sell side liquidity level, now I'm going to be looking for a swing high. So the nearest swing high, the latest swing high that was created was at 955, as we could see right here. Now I'm keeping my eye on that 955 swing high. And the reason being is because I'm trying to see if that swing high is going to be broken and displaced through or not. Because if it is, then I'm going to be going on to the next step and eventually trying to execute a trade. So as we can see right here, this swing high has been broken through with this candle right here. And we get a displacement and a market structure shift with this 1003 candle. Now we get this candle to close way above this swing high, which is considered to be a market structure shift and a displacement towards the upside. Now, this is a great sign for me, as it is showing me that price is willing to go and seek higher prices. So after we've managed to form that market structure shift and displacement towards the upside, this usually often creates a fair value gap. As we can see right here, a fair value gap has been formed at 1003. Now, essentially what a fair value gap is, a 3 candle pattern. In this bullish example, let's say this candle is going to be labeled as number 1. This candle right here is going to be labeled as number 2. And this candle right here is going to be labeled as number 3. Essentially, what a fair value gap is, the first candle's high, as we can see right here, and the third candle's low are not overlapping. And essentially, there is an inefficiency. There is a price gap where price has not filled yet. So the next step that I'm waiting for is a retracement into that fair value gap. And as we can see right here at 1005 within the macro, we do get that retracement into that fair value gap. So that's where our entry is going to be. As soon as price retraces into the edge of that fair value gap, I'm executing my trade going long. So after I execute my trade going long, I'm placing my stop loss below this candle's body low right here, risking about 27.5 handles, which is great because it is less than 30 handles. And we always know that we only risk 30 handles max per trade we take. Now, what I'm targeting is this swing high right here for 1 to 1.4 risk to reward. And as you can see, price absolutely delivers ever so perfectly and hits our take profit. Now, let's talk about trailing our stop loss. It's very important to trail your stop loss in order to reduce risk as much as possible. My rule of thumb is, as soon as we take a swing high and we break above it, so let me just move this to the side for a second. So as soon as we break a swing high, as we can see right here, there's a swing high here, and we break that with this candle right here, we close above it, then automatically my stop loss is going to be moved up to the nearest swing low, which is in this case, this swing low right here. And there we go. We just reduced our risk. And now instead of risking 27 handles, we're only risking 20 handles and a half. Now, again, as we can see right here, price does create another swing high. And we see with this candle right here, we do break this swing high right here. Price closes above the swing high. Now, what I want to do is I want to get my risk and I'm going to reduce it to this swing low right here. Now, we're only risking 10 handles and 3/4. So I'm always going to be reducing risk. I want to be always reducing the amount of risk I have on the table, but I don't want to reduce risk too early just so I don't get stopped out. The reason why I'm reducing risk is because if price would come back down and take this out, it's more likely it will continue to the downside. So that's the logic behind reducing your risk and always having your risk below a swing low every time we take a swing high. And as soon as I saw that price pump above this swing high right here and have a big push up, I'm reducing my risk all the way to break even. Now I'm break even. It's a risk-free trade. I'm not expecting price to come down and take this swing low. And I'm definitely expecting price to leave this fair value gap considered to be a breakaway gap. I'm expecting price not to come back and touch this fair value gap and just continue to the upside. And it did ever so perfectly. And you might say, well, the risk to reward is not 1 to 2. And I agree with you. It's not 1 to 2. It's a 1 to 1.4. But we always take what the market gives us, all right? It's ideal for us to have at least a 1 to 2 risk to reward. But if you do realize and look at the high time frames, this trade was actually taken in a bearish market state. Some of you guys could be targeting London highs, as we can see right here, which is a 1 to 2.76, which is a great risk to reward. But again, if you look at the high time frames, price was maintaining bearish order flow, and you got to keep in mind that price is not always going to go to your take profit, the maximum take profit that you do put on. So that's why, again, you're always going to be aiming for low hanging fruit. That's what profitable traders like myself do. We aim for low hanging fruit. We don't aim for the maximum amount of fruit up the tree. No, we just aim for the lowest hanging fruit. And the more small wins you bag every day, every couple of days, every week, every month, it will add up and you'll eventually see the amount of money that you'll accumulate. So if you look at the 4-hour time frame here, from 13th of August, we were bearish. If you see right here, we do respect this 4-hour fair value gap to the downside. And then we have another 4-hour fair value gap right here where we respect it and we push down. So we were bearish throughout the whole pretty much of last week as well. So that made me also think, okay, price might not want to reach all the way to the other side of the session, which was session highs at London highs. So I had that in mind and I targeted the lowest hanging fruit. That's what you guys should be also doing. If we go down to the 1-hour chart right here, again, we had bearish order flow, fair value gap, retrace, drop, fair value gap, retrace, drop, fair value gap, retrace, drop, fair value gap, retracement, drop. So I had in mind that price was bearish. So I wanted to get in the market. As soon as we get in, we want to get out as quick as possible in those situations where the market's actually against us. So I'm pretty much catching a retracement. As you can see right here, we do catch a retracement into that 1-hour fair value gap. This is where our trade was right there. Price swept London lows. We took the trade based off of our entry model and we retrace back into that 1-hour fair value gap and we drop. Comes back, retraces, and then drops, and then keeps on dropping. So there you have it, guys. The ICT silver bullet model in play right in front of you guys. If you guys do have any questions, make sure to put them down in the comments down below and I'll be sure to answer them and get back to you guys within the 24 hours or less. I hope you guys enjoyed this one and see you in the next one. Peace.